Picture this, buying 7 PE value stock, then watching it stagnate or crash over the decade while 80 PE growth machine like Nvidia compounds 50x. Does PE even matter for buying and hold for long term? As Warren Buffett says, he skips it completely. Market cycles destroy naive PE bets. I'll prove it to you with the real business examples, my portfolio wins and losses, and timeless fixes. If you are building wealth investing in stocks, stay tuned and hit that like button. PE basics is just stock price divided by earning per share. $100 stock and $5 EPS equals 20 PE. Seems cheap, really? But for the long-term compounding, PE ignores operating leverage for the rocket fuel of great businesses. As an example, Tesla 2012. Tiny revenue, negative margins. By 2025, they grew up to 100 billion plus company and 11% of margin, economies of scale, cost per car plummeted. And I actually sold it very early because I saw that PE is so high. Myth number one for long-term holders. Low PE isn't an automatic value. It's often a dying business trap. In my long-term portfolio, I bought companies like PayPal, which we are calling painful now, and I didn't get return in years. Yeah, so I eventually sold it because I saw that the company is going nowhere, even with the growth, even with everything. It was just a value trap, in my opinion, because the company is growing slower and slower, and that was valued into it already. Very often, low PE hides shrinking modes and no reinvestment power. It is a compounding killers, basically. Yeah. It's not all the time. We'll discuss this later as well. Myth number two, avoid high PE at all costs. For example, average tech PE is between 30 and 50, and it still compounds 15-25% growth compounding, so is it a bad investment then? Yeah. Banks' average PE is between 10 and 15, and they're giving us only 3-7% of return yearly, so it's not so good as tech, for example. Yeah, and an energy average PE is between 8 and 12, and it really depends on the cycle. So sometimes you will see negative return, and sometimes you will have like 8% maybe. And 8% is still not great. It's just better to invest in S&P 500 on Nasdaq, and you will not need to think and analyze the stocks. As an example, Amazon pre-2016, wild PE swings, hundreds negative from reinvestments for scale, and as a result, we see that it's exploded by 20x, and profits exploded as well. I avoided high PE of Microsoft in 2020, and I missed a lot. But of course, I was investing into different stocks as well. Not all of them were performing like Microsoft, but still, I missed that, and I love Microsoft company. I'm invested in it now, but I missed a lot. Myth number three, cycles don't matter. PE ignores devastating cycles that wipe out long-term gains. Do you remember dot-com bubble at 2000? PE went up to 44 for SPY, and then it crashed up to 14. Markets were down about 60% over the years. Today's share PE is about 35, and it signals bull euphoria. Buffett hoards 200 billion in cash waiting for cycle lows. High cycle PE buys bleed capital through drawdowns. Buffett, genius for multi-decade compounding, ignore PE screening at all. He always says that you need to understand business for multi-years forward. As an example, Geico Insurance, predictable modes, steady 10-15% return. In my portfolio, journal modes now come first before numbers. If I don't see the mode in the company, probably it's a high risk investment. What I'm watching is pricing power, switching cost, and PE is probably a trailing indicator at best. This shifted me from the traps and compounders. I don't ignore PE fully. If I'm watching like the mature company, then I'm watching PE as well. But if it's a growth company, PE is not like a minor factor for me. If we're talking about valuations for my real long-term portfolio, I'm watching back. It's PE divided by growth rate. If it's under 1, it signals compounding magic for me. I also watch forward PE. By forward PE, I can see the growth of the company as well. It's rising margins. And as I mentioned, one of the main points is mode for me. And I have some checklists there, like I'm checking like 10-year revenue, CAGR is over 10, for example. ROIC is over 15. For me, these numbers are really important, not just PE ratio. PE ratio doesn't tell much, to be honest, especially if it's a high growth compounder. In my opinion, PE shines in narrow long-term cases. For example, versus industry peers. If I'm comparing companies in the same industry, tech to tech, Facebook to Microsoft, for example, yeah, or Google to Microsoft. Point two, major phase, post-leverage scale achieved. For example, the company is not growing so fast already, but they have a great moat and they are very stable in the market. This can be McDonald's, this can be Coca-Cola maybe, or PepsiCo. Point number three, cycle bottoms. When we had a huge crash, it's always a great buy usually, yeah, but of course we need to check everything there, like moat, growth runway, and management quality, and so on and so on. Yeah. But usually PE works after big crashes. Final truth, PE fails standalone for long-term investing. Leverage, cycles, and business modes rule compounding, in my opinion. Smash like if this reframed PE for you and subscribe for the updates. And what are your biggest PE lessons?